Okay, we ready to restart, Mr. Jones? Okay, perfect. Again, this session is going to be carried out by Ben Meng from the Investment Office and Asset Allocation, and it's going to be also involve Alan Milligan and Dave Lamoureux from the Actuarial Office. The point of this session is to literally do a preview of some of the potential candidate portfolios. This information will come back again tomorrow morning, and then we'll come back again when we get to the actual clicker exercise. So we don't have to beat this particular iteration of the data to death. So this is simply a preview so that people can think about this overnight. Ben?
Thank you, Eric. We'll probably finish today's workshop with the most important topic of the day, which is the detailed analysis of the preliminary candidate portfolios. And knowing that I'm the one standing between you and 6 p.m. Dinner reservation, I will try to speed it up. And before I get into the details of the analysis, I would like to acknowledge my colleague Paul Zhang, who's sitting on the far right, who did most of the modeling work on the asset side. As we know that asset allocation, the majority of it is about the trade-off between the good and the bad. The good being the expected return, the bad being the volatility around the expected return. And traditionally, this risk and return trade-off is conducted in a theoretical abstract framework. So to engage in a more meaningful dialogue, instead of using this abstract theoretical framework, we work together with the Actuarial Office to develop this integrated asset and liability decision-making framework, which will help us to translate this abstract concept into something much more tangible, such as the 3 key risk considerations: the future funded level, future contribution rate, and the volatility of future contribution rate. Once we can translate the abstract concept into the tangible measures that we feel we have a strong opinion about, then we can make a much more intuitive selection in terms of the next policy portfolio. And also we would like to highlight is that the investment beliefs that you adopt in September this year are fully incorporated in this decision-making process, especially during the process of selecting the candidate portfolio. As I mentioned that the selection of the candidate portfolio later on this year or early next year will be assisted by the 3 key risk considerations, which are the future funded status, contribution rate, and contribution rate volatility. And these 3 key risk considerations are jointly determined by the asset considerations as well as the liability considerations. And this actually is precisely the motivation behind the collaboration between Invo and Acto to work together to develop this integrated asset and liability decision-making framework. So as you have seen a couple of times today already, the first investment belief that the liability must influence the asset structure. And second, the other 2 investment beliefs that we follow closely are investment beliefs 6 and 7, which when we picked a candidate portfolio or the preliminary candidate portfolio, we pick them off the efficient frontier because it is our objective to maximize the return for a given level of risk. At the same time, we also understand or recognize that risk to CalPERS, which is investment belief number 9, is multifaceted. So that understanding tells us that it's neither prudent nor practical to select a new policy portfolio based on one single risk consideration. Instead, we should make that choice based on a number of key risk considerations. So what these newly developed asset and liability integrated decision-making framework can do for us. So what it does is translate what our analysis finds that using this decision-making framework, we found that there's a strong, positive, and close linear relationship between the investment choice, which is the volatility in the investment portfolio, and the future volatility of funded status and the future volatility of a contribution rate. Further, we also found that the sensitivity of future funded status volatility or future funded status dispersion to the investment risk we take today is closely related. That sensitivity is closely related to the funded status today. Also, the sensitivity of contribution rate volatility to the investment volatility is closely related to the asset to payroll ratio and also the discount rate today. So this is the high-level summary, and in the following slides, we show you more details of this analysis. So on this slide, we show you the inner workings of this integrated asset liability decision-making framework. You see two boxes on the top. On the top left boxes, listed are the three key investment risk factors, which you first saw this analysis from the staff June this year, where we used the soup analogy to illustrate how we can decompose the conventional asset class returns into different risk return premium. So we tentatively selected 5 risk factors, which are the real interest rate, realized inflation, expected inflation, volatility, and growth. So on the top left are the assets, are the consideration from the asset management side. Then on the right top box are the key considerations by our actuarial office on the liability management. And these considerations such as the choice of a discount rate, our forecast of inflation rate, amortization policy, and smoothing policy. So once you have the top and left, considerations that from both asset side and liability side, we put these considerations into the integrated decision-making framework. And the output of that decision-making framework are the 3 key risk considerations listed at the bottom. Again, funded level, contribution rate, and volatility of contribution rate. And it is our hope that with the help or the aid of this integrated decision-making framework, we can make much more intuitive choice of the policy portfolio. Yes, Mr. Jalansi.
I understand how expected inflation is an investment risk that helps drive your investment decisions. But realized inflation is something you see only in the rearview mirror. And so it's kind of hard to see how that actually helps drive an investment decision, which is something that you do today going forward.
Yes. So what we found is that realized inflation has significant impact on certain asset classes, such as real estate, commodity, and forest land. So these kind of asset classes respond both to the expected inflation going forward and also the realized inflation. So that's the economic intuition for inclusion of these factors. And also they are relevant to us, as I mentioned earlier this morning, that our liability is closely tied to the realized inflation, not expected inflation. So for us to truly have integrated asset and liability framework, we should include both expected inflation and realized inflation as in this new factor-based framework.
Except the realized inflation is not a factor you can use in making an investment decision.
That's correct. So for ex ante to make investment decision may be less useful, but for us to understand in terms of match our liability, do we have enough assets to match the inflation linked liability?
Okay.
Yeah.
Thank you.
Thank you. So this is the first attempt of ours to show you the output from the integrated decision-making framework. On this slide, we show you the sensitivity of funded level dispersion to the investment risk that we are taking today. And on this slide, we show you 2 programs. The left chart is for the state miscellaneous plan, and the right-hand chart is for CHP safety plan. The x-axis for both charts is the investment risk, and then the y-axis are the dispersion of a future funded level. So what we did here is that for each risk level along the x-axis, we did thousands of simulation of a future potential portfolio returns, and then we compute the dispersion of that scenario, and then we plot the red diamond here. We plot each one of the results on the chart, and then we run a linear regression through all the lines to connect them together. So what we found a very strong positive close linear relationship between the investment risk we take today and the funded level risk in the future. And for state miscellaneous plan, we found the slope of the line, or you call the sensitivity, is 0.68. So 0.68 means that for any 10% additional investment risk we take, we will see 6.8% of an increase in future dispersion of a funded status. So for state miscellaneous plan, it's 0.68, the sensitivity. And then for the CHP plan, it's 0.64. So the very first question, when we saw this number, we asked ourselves, we are very intrigued. Why 0.68 for state miscellaneous plan, and it is 0.64 for CHP safety plan? Yes.
So it's investment risk to the range of funded levels, not necessarily investment risk to the funded level.
Correct. To the range or to the dispersion of the funding levels. Yeah.
Okay.
So you can think of as the sensitivity of the dispersion in investment risk. How is that translated into the dispersion of future funded status?
Yeah, the more risk, the greater the volatility, the greater the volatility.
Yes, exactly. So that's a positive. The translation coefficient, the 0.68, is not a one-to-one translation. So as I said, we were intrigued why the number 0.68, 0.64. So to answer that question, on this slide we showed, actually we analyzed these for 6 plans, right? 3 miscellaneous plan and then 3 safety plan. For the 6 plans, the second column you see on the table, we list the sensitivity estimated from the linear regression, the dotted line. And then the last column, we listed current funded status of the plan. As you can see, the difference between these 2 columns are very small, so which makes us believe that we can approximate the sensitivity by using the current funded status. So, yes.
So this is one year you're looking at. You're not looking because, so there's not a chance here for all the contribution policies and everything to feed into it. You just look 1 year, you've got a certain, okay.
Yes, so you were right.
I get it.
So we look at the 1 year distribution, the dispersion. The reason because beyond the first year, the second and third year will become path dependent. Will be difficult to model that dispersion.
But it does seem like it would be, now that you say it, that the factor would be tied to the current funded status. I mean, take an extreme where the funded status is 30% or something like that, as your next table shows.
Yes. So actually that highlighted very consistent with what our chief actuary just talked about, the flexible de-risking.
If you were at 100%, wouldn't it be 1-to-1?
Yes, exactly. So that's why as the funded status of our fund improves, it is more important, getting more and more important to engage in the flexible de-risking practice because you get most bang of the buck. As a higher it become more sensitive to investment risk. Yeah. Exactly. Yeah. Right.
This is just a statement of Alan's asset to liability. I forget what risk you call that. You know, the more assets you have, the more risky you are.
I think we were talking about the asset to payroll ratio,
Yeah.
which you will see in the next slide.
Yeah, if you have no money, investment risk doesn't matter.
Okay, so on that
Yep.
on that happy note, we move on to the next. So now we would like to take a closer look at. So we just look at the sensitivity of investment risk on one of the 3 key risk considerations, which is the funded level. Now let's take a look at the sensitivity of investment of the other key risk consideration, which is the contribution rate dispersion. How does that respond to the increase or decrease in investment risk? So following a similar approach, on this slide we show you again the same 2 plans, state miscellaneous and CHP safety. And the x-axis against the investment risk. So for the state miscellaneous plan, for any 10% of increase in investment volatility or investment risk, we see 0.8% of increase in the contribution rate volatility. Not the contribution rate level, it's the volatility around the level. And again, as with the previous slide that, we were intrigued by this number, is there any approximation? Yes, Mr. Janasik.
When you were doing this, did you find any relationship between the risk and the level of contribution?
Yes, we did. That's in the appendix.
Okay.
Yeah. So again, we show the 6 plans that in total we analyzed. The second column is the sensitivity from the regression from these 2 charts, the sensitivity. And then the third column, we show you that using a formula to estimate, can we approximate the sensitivity so that we don't have to run hundreds of thousands of simulation every time when we want to know the sensitivity. So what we found a very close, again, linear relationship between the sensitivity and the asset to payroll ratio. So this positive, strong correlation, what does it really tell us? There's a lot of numbers and columns on this slide. So this tells us that if reducing contribution rate volatility is our primary concern, there are a couple of ways to do it. One is to reduce the risk in the investment portfolio, or to reduce the discount rate, or reduce the asset to payroll ratio, or the combination of all of the together. So if that's the major concern is to manage the volatility of contribution rate, there's a few things that we can do here. So in quick summary, what the integrated asset and liability decision-making framework revealed is that there's a strong positive relationship between the investment risk we take today in our asset portfolio and the future risk around the funded status, and also the future risk around the contribution rate.
Excuse me, Ben,
Yes.
did you also say that it's a function of the smoothing factors too? I mean, how fast you ramp up the contribution rate?
Yes. So the very good question. So
You could ramp it up slower, but of course, you just pay the pipe. You defer the, yet, again, this is just the first year impact, is it?
yes, yes. So I'm back to slide 10. You see the footnote there, the list of the exact estimation, how we came up with the number on the third column under the blue estimate sensitivity. And as Dr. Deere pointed out, there's a coefficient 0.2 in front of it because now currently we have the smoothing policy of 5 years, so we're taking 20% hit every year. Okay, so the preliminary candidate portfolio. So with the help of this integrated asset and liability decision-making framework, we picked 4 candidate portfolio on the efficient frontier. The efficient frontier is the solid blue line showed on this slide. Again, the x-axis is the volatility of the investment portfolio, and then y-axis is the expected return. And as you may recall, that efficient frontier is consisted of the portfolio that for each given level of risk on the x-axis that gave us the maximum expected return. And once you plot these all the portfolio together, that gives us the efficient frontier. And we're showing you 4 candidate portfolio or preliminary candidate portfolios on the efficient frontier represented by the red diamond. In addition, we also show you 1 low-cost portfolio represented by the green triangle. As you can see that the green triangle is not on the efficient frontier. The advantage of this low-cost portfolio is indicated by its name, which is low cost. And in addition to the low cost, this portfolio is also highly liquid and very transparent. But the drawback of a low-cost portfolio, again, as shown on this chart, is that it's not efficient. It's suboptimal. But that is only true. This low-cost portfolio is only suboptimal if we choose to stay within the conventional modern portfolio theory, where we only regard volatility as the risk. However, as I said earlier on, once we factor in other risks, such as liquidity, ability of generating income, and transparency, the low-cost portfolio may not be inferior at all.
So it's just cap weighted.
Just cap weighted. Oh, yes.
Well, and I guess I would argue, too, that that cost is something we can actually quantify a lot better than, and predict perhaps a lot better than than returns. So,
Yes, so that's a very profound observation, actually. The cost, every $1 you save, there's no volatility around that. It's a $1, hard $1. The expected return always comes with a volatility or uncertainty around it. So the quality of a return from cost cutting is much, much higher. Probably the highest source of a return if you can cut cost. Yes. Mr. Janansik?
No.
Oh, okay.
Admit.
The other observation we would like to call your attention to is that if you look at the 4 candidate portfolio on the efficient frontier, they are kind of clustered together. This is mainly because of our current funded status and also the capital market conditions that we are operating in today. So all of our candidate portfolio are the farther out of the efficient frontier. They are return-seeking portfolios. So these are the 2 key observations on this slide. So on this slide, we show you the detailed composition or allocation of each one of the preliminary candidate portfolios. And this slide may be slightly different than what you have the hard copy. You may not, if you're looking at the hard copy, you may not have the last column. So we added the last column, which is our current policy portfolio. So if you look at this table, if you look at the row by row first, for private equity, real estate, infrastructure and forest land, and liquidity, for these 4 asset classes, for the first 4 candidate portfolios, they are exactly the same. So the only variation for the first 4 candidate portfolio coming from public assets, global equity, fixed income, ARS, and inflation asset classes. So now if I look at, let's move from the left to the right. So that means from the lower risk portfolio all the way to the highest risk portfolio. Low cost portfolio actually is the highest risk portfolio. If you recall from the previous slide, low cost portfolio, on this slide, sorry. Low cost portfolio has the highest expected volatility, which is slightly over 14%. So if we move from the left to the right, if you see that low-cost alternative portfolio and the low-risk alternative portfolio, the second column, and the low-risk portfolio, the third column, the only difference between these 2 is the allocation to ARS. The second column, the low-risk alternative portfolio has 5% allocation to ARS, while in the low-risk portfolio, the third column, we have 2% allocation to ARS. And the 3% difference is split between global equity and fixed income. So if you compare global equity between the low-risk alternative and low-risk portfolio, there's 2% difference. And then between fixed income, there's another 1% difference. So these 2 represent the low-risk portfolio on the left part of the efficient frontier. And once we move over from there to the base portfolio, by the way, the base portfolio is very similar to our current policy portfolio. So moving away from the low-risk portfolio to the base portfolio, you see a higher return, a higher allocation to equity and lower allocation to fixed income. And that theme carries out to further to the right. When you see the higher return portfolio, again, we see even more allocation to global equity and even smaller allocation to fixed income. And then the second to the last column is a low-cost portfolio that is predominantly allocation to global equity with over 80% allocation to global equity and less than 20% of allocation to fixed income. So that is you go from left to right to look at the allocation of each candidate portfolio. And then on the bottom 3, yes, Mr. Jones.
I'll go ahead and ask the question now. We just finished talking about ARS, and I see it again as an asset class on this sheet, and we just said that it wasn't a few minutes ago.
Yep.
The second question I have is, where is the discount rate? I see at the bottom you got the expected compound return, the blended return, expected volatility, but where is the corresponding discount rate?
Okay. Thank you. Both of the very good questions. On the ARS being an asset class, what I said early on, apologies if I didn't make clear. I meant is that there's an option. If you look at the low-cost portfolio as an option, the low-cost portfolio does not have ARS. So that's answer to your first question. The second question, in terms of discount rate, I think that I will defer it to our chief actuary, Alan Milligan.
So with these, in addition to the different portfolios, we're also showing you the various different risk characteristics associated with two different levels of margin for adverse deviation, either essentially no additional margin for adverse deviation, or a 1/4% margin for adverse deviation. So the discount rates associated with each of those portfolios, the two lower risk ones, we would be looking at a discount rate with no margin of 7.25%. And with a 1/4% margin, that would be a 7% discount rate. For the base case, we'd be looking at a a discount rate of 7.5% with no margin, which is what we currently use, and 7.25% with a margin. For the higher return portfolio, we'd be looking at a discount rate of 7.75% with no margin, and 7.5% if we had a margin for 1/4% margin for adverse deviation. The lower cost portfolio would also have a 7.5% discount rate with no margin, and a 7.25% discount rate with a 1/4% margin. We could provide that for you tomorrow if that's what you would like.
Would you please? Okay, thank you.
Thank you, Alan.
Ben, can I
yes,
also
please.
jump in
Yes.
for a second? I think the answer on the absolute return strategies is that it's being called an asset class component here, but it's really a program and it's just a separate allocation. So it's, but can I just ask a question? So the lower cost option is really not realistic given where we are today and how much we have in the private asset classes. Did you consider something in between that was lower cost or moving us, ratcheting down our allocations to the private asset classes, but not eliminating them completely?
Yeah, that's a really interesting question. And if you flip back for a moment to the efficient frontier slide, can you go back one, Ben? You actually see the value of the private assets, because basically the inclusion of the private assets it goes from the green triangle back, if you move immediately to the left, basically, to hit the same expected return level. You, in essence, are dropping almost 1.5% in terms of volatility and risk, and that is the real benefit that comes from the private assets. And we certainly can attempt to model that, and we can collect feedback on that basically tomorrow when we ask you about the constraints that have been applied. So if you give us guidance in that area, we can work to see if there's a solution that can be calculated.
And then the liquidity
changes.
component on the lower cost option, you dropped it because you don't need liquidity to cover capital calls, is that?
That's exactly right,
Yeah.
because then basically you're invested into assets that are almost
Very liquid.
perfectly liquid across the entire portfolio. So it's all public equity and public fixed income.
Okay, so you don't feel like you need additional liquidity to cover, benefit payments, et cetera?
Well,
The
we
liabilities.
always have to manage the capital demand for the benefit payments, and
Yeah.
that demand is going to increase over time. What we don't have are things like capital calls that would be coming out, attached to private equity and real estate. So you're removing an entire source of potential volatility, and those numbers can at times be big. So
Right.
it basically, that just removes that management challenge, if you will.
But is there not still the potential that we could have some kind of market crisis where it would be very expensive for us to sell our securities, and we might still need to sell them in order to cover our liabilities?
The majority of a fixed income portfolio is very liquid. The majority, I want to say, is treasuries and mortgage pass-throughs. So 18% of the low-cost portfolio allocated to fixed income, and also a big chunk of public equity, I want to say, under even on the stress market environment, is quite liquid as well.
Yeah, I mean, literally adding back a liquidity reserve into any segment of these portfolios, it's simply just, it serves to basically diminish the return a little bit. There's an
Yeah.
opportunity cost attached to it. And by the way, though, it also diminishes a little bit of the risk because those liquid assets tend to have very low volatility attached to them. So just depending on the objectives of the organization, the liquidity reserve can be built, it can be expanded, it can be contracted, depending on what
Okay.
we're trying to achieve.
Thank you.
And on the earlier question on the validity of the low-cost portfolio, I guess the way to say that the jury is still out because we know, probably Joe can opine on that as well. CPP, the Canadian Public Pension Fund, runs a kind of a private asset class-centric portfolio, and then the other sovereign wealth fund, the Norwegian, runs a public-only portfolio. So if you look at the track record, we have some track records are not long enough. That's why the jury is still out, but that's something I think we should continue to monitor the development of that.
But it's not something we could implement within 3 years even, so, right?
Right. I think we get caught up with these average returns. And, okay, at the average, you can live with 81% with 14% standard deviation. The risk is if you have an 80, excuse me, an 08 and 09, and 81% of your portfolio is in a single asset class, and that single asset class goes south, and what you really care about is the far left-hand side of the distribution. And that's what the diversification is all about. I mean, and that's what you're paying for, and you pay dearly to get diversified. And that's what you need to accept. Are you willing to pay that amount so that you don't take a 40% hit in the portfolio, which you may never be able to recover from? And that's where I think the focus of the discussion should be.
Yeah, we could certainly also calculate the concentration and growth risk, but I believe that with an 80% allocation to equities, that growth risk concentration would be even higher than the 90-odd% that we currently run.
We have the information in the following slides.
Okay.
So you're right, Ms. Mather. We couldn't implement this portfolio quickly, but we felt strongly that we should put it up because there's a lot of question going on about whether the fees paid to private equity and hedge fund managers and real estate managers is justified because they appear to normal people, if I can put it that way, to be way out of line to the value added. But this illustrates really clearly the important role they play in our portfolio. Doesn't mean you can't go that way. I mean, we would save $1 billion in fees eventually, and staff required inside CalPERS would be much smaller than we have today. The complexity of your job in terms of the choices you'd have to make and the portfolio supervision and oversight that you'd have to do would be much less. So we thought it was important to put it in and treat it seriously. I frankly was a little surprised that it didn't fly on the efficient frontier and that the volatility was higher. But then on second thought, it's like, well, yeah. And then what Alan said, I mean, equities were down 50% in that year, so 80% of the portfolio suffering a 50% loss. It's really something to think about. Now, if you can hang on, you know, it came back, but you know, instead of being down 24% and kind of being at the tail end of the public pension fund world in terms of losses, we would have been down more like 40% in a unique category of worst performer. And you really want to ask yourself how that feel. You know, could you live with it?
Mr. Chair.
Well, I just want to point out, building a efficient portfolio using inefficient blocks gets really interesting. And that's true in the lower costs as well.
Point well made.
And I'll probably make it again.
Seeing no further questions, now I would like to turn this presentation over to our actuarial office, who will show us what each one of the potential candidate portfolio, what it means in terms of the 3 key risk considerations.
Thank you, Ben. So the three risk considerations we're talking about, Ben mentioned them before. It's the contribution level, like how high a contribution rate we're looking at, the probability of reaching that level. Then we have the contribution rate volatility, that's the year-to-year changes in contribution rate, and the funding level. And so what we did here is we just selected some parameters to use for the analysis. And what we did is we looked at 6 plans, 3 of them being of what we call the miscellaneous categories, and 3 for safety employees. So we selected a 35% contribution level for the miscellaneous plans, a 3% year-to-year change as our threshold, and a 50% funded. The 50% funded was the same for all plans. What we varied for the safety groups is generally they're subject to more volatility, and the contribution rates tend to be higher because they're subject to a higher benefit level. So we selected 45 a contribution rate level and 5% year-to-year changes. Just some key things to keep in mind. Some are obvious. I think some were made today. So you have 5 portfolios in front of you, some being lower volatility, some higher volatility. With higher volatility comes higher expected returns, and as was mentioned earlier, you have a higher probability of being better funded also under higher risk, and you could see lower contribution rates long term. But also, as volatility increases, you also have higher probabilities of reaching lower funding levels and higher contribution rates. And another thing that will be shown on the next few slides that will follow, it's something that we'll be asked to provide guidance on tomorrow, is what's been referred to as the margin for adverse deviation, or the cushion. Do we want to add another level of conservatism on our discount rate assumption? So on the charts that follow, we've added 25 basis point margin or cushion on the discount rate assumption. So the first one here, there's a lot of lines. You've got 3 charts, but the best way, this is for state miscellaneous. So the chart on the left side, and that will be the same for the next 6 slides, the chart on the left side shows you for the contribution level. So what is the probability of the contribution rate reaching 35% of payroll or higher? And you've got
in 30 years. Once in 30 years.
You've got the probability of this happening once over the next 30 years. So this is what you're looking at. And you have 5 sets of bars, and they represent the 5 portfolios that we're looking at. So the first bar on the left, listed as the lower alternative risk, that's, if I go back 3 slides, that's the first column on the left here. So the 5 columns you see on the table represent the 5 sets of bars you see here. So on the first chart, the line on the left shows you with no margin, so 7.25 on the left. The first set on the left will be a 7.25% discount rate versus a 7%. So a few of the things I want to point out here is, as you move to the right of each chart, that means more risk. So when you look, especially in the middle chart, which is the probability of seeing a more than a 3% change in the rate in any given year over the next 30 years, you consider that probability. The more risk you take with investment, the higher that probability is. You see the same pattern on the funding levels as well. The chart on the right shows you the probability of seeing your funded status drop below 50% at least once over the next 30 years. Again, the more risk you take, the higher that probability is.
Mr. Johnson?
Yes.
Yeah, going back to the higher expected, the previous chart or slide, the higher expected return really is a long-term trend. And if we're long-term investors, we ought to do that. The volatility is very short-term. And I remember when my own contribution went from 5 to 8, there was a 60% volatility, and I don't remember anybody saying, "My God, we can't impose a 60% volatility on the employees." So we need to, I think, take a little broader viewpoint and remember the employees as we do this.
Thank you. The other few things I want to mention, so if you look, when you look at lowering risk in the portfolio, we're going to be talking about the concept of margin tomorrow. two things I want to like point out. If you want to compare to see how does having a margin or taking less risk compare, if you look at the base case sets of line you see on this chart, so let's just look at the middle chart with the contribution rate, the changes in contribution rate. If you look at the base case, if you look at the line, the orange line on the left, that's under a 7.5% discount rate. If you look at the sets of bars just to the right listed as higher return, that has as a, without a margin, which is the orange, 7.75 discount rate in it, or with a margin, a 7.5. So if you want to compare kind of the both, you can kind of look at these two bars there. But basically the main point here to get from all of this is the higher risk you take on the portfolio, the more, the higher the probability you have of at some point getting a lower funding level, the higher the chance of getting a higher contribution rate, and also seeing higher changes from year to year. On the, yes.
So I think really kind of to reinforce what David was saying is that the no margin on the base case and the with a margin on the higher return both have the same discount rate. And you'll notice that, in fact, those two bars are actually very similar. So whenever, with any of these charts, when you start comparing the asset allocation and a margin that both produce the same discount rate, you will tend to see very similar risk levels. And so this kind of is the point that George was talking about earlier, which is that the risk-return trade-off is very real. There's more than one way to change the risk characteristics, but they tend to have very, the costs and the costs of the risk trade-off tends to be very similar. There's some fine-tuning between these. You may want to say, well, look, the 7 3/4, the higher return portfolio with a 25% basis point looks pretty good, which I would agree. But the base case with no margin also looks very good, and in fact, maybe slightly better. So in terms of assessing these risk-return trade-offs, you may want to keep in mind which ones have the same discount rate because their impact on the employer contributions, especially in the short term, are very similar. Different ones that have different discount rates will tend to have a different impact on employer contributions.
Perfect. Thank you, Alan. And just in the interest of time, we've got 5 more slides that follow that have a very similar pattern. They're just for the 6 plans we were looking at: public agency, miscellaneous, the schools pool, the safety, the CHP, a public agency safety plan, and the state police officer firefighter plan. And in all of them, if you look, especially if you look at the 2 charts, the middle one and the one on the right, you're going to see the same kind of pattern. The more risk you take, the higher the probability is. Any questions on these charts?
I do notice it a little bit surprising at first that the probability of contribution rate exceeding 35% is on the state miscellaneous. It is reduced as you go to higher returns, but on the other, most of the others, it's PA miscellaneous. It's about the same for all of them, and it's actually for schools. It's lower.
So
CHP safety. I guess it probably depends on their funded status to start out with.
yeah, it's a function of where they are today.
Yeah.
And where we're already expecting that rate to go over the next few years. And the issue, what happens, especially when you, let's say, lower the discount rate, it triggers automatically a rate increase. Because you assume a lower discount rate, it raises the normal cost, a contribution rate. So in the case of state miscellaneous, because we picked a 35% rate threshold for the analysis, had we picked something like 40 or 45, I think it would have given us a chart closer to schools and the public agency miscellaneous. So it's a function of where it is today. So, which is why you see something similar as well for the safety groups. Had we picked a higher threshold, like 50 or 55% of pay, you would have seen something similar to what you see for schools and the public agency miscellaneous. JJ.
When we reduce the discount rate, it increases the unfunded liability. I mean, the cash flows are exactly the same, but the reported number gets bigger. Since we now have a bigger number to amortize over the same number of years, we need a higher contribution to do that. And I'm wondering if it winds up just being a big offset.
It's not an offset, but there is some offsetting effect. So that is one of the reasons why, you know, it's really very difficult to reduce the risk of a high contribution levels. Because in order to do that, you need to reduce the contribution volatility, which reduces the expected return and increases the rate. So it's almost, you know, to a certain extent, self-defeating. It is very difficult to try to limit the possibility of high contribution rates. And that is one of the things that we are very struggling with in our analysis.
Thank you.
Okay, seeing no other questions, I'll pass it back to Ben.
Thank you, David. So David showed you a lot of charts because we analyzed 6 plans and total 5 candidate portfolios that total 30 charts already, and then with and without the margin, then total 60 charts. So let's take one example and give you some numerical examples. Before I do that, let me go back to this slide. So what we observed is that we show you 4 preliminary candidate portfolio on the efficient frontier, and they are kind of clustered together. At that part of the efficient frontier, the curve is relatively flat, which means that taking on additional risk, which is x-axis, the additional gain in the y-axis is small. So in that area, our estimate is that for any 0.25% of increase in the y-axis, we had to take on 1% of increase in the volatility. So basically, it's a 4-to-1 ratio. The good to the bad is 1-to-4, basically. And the question we should be asking ourselves is that trade-off we would like to do for every 25 bips or 0.25% increase in expected return? Are we willing to trade for 100 bips or 1% increase in the volatility? So as we said, that's trade-off a little bit abstract. So what we did is that let's pick one plan, look at the lower left table, the second column, the state miscellaneous. So if we do that trade-off in the risk and return trade-off, what does it really mean for the 3 key risk considerations for the state miscellaneous? So if you look at the second column, the first number is that if we increase the expected return by 25 bips and then increase the volatility by 100 bips, which means that the probability for employer contribution rate to go above 35%, that probability is reduced by 4%, which is good. That's the outcome that we are in favor of. However, if you look at the other 2 measures or key risk considerations, if we increase volatility by 1%, it also increases the probability of employer's contribution rate volatility to go above 3%. We increase that probability by 8%, which is a result that we are not in favor of. And also similarly, the same direction is that 1% increase in investment volatility also translates into a 4% increase in probability that this plan, the funding level will be below 50%. We increase that probability by 4%. Again, that's not an outcome that we are in favor of. So on this slide, we show pick a few plans, a numerical example, what exactly this integrated asset and liability decision-making framework enable us to do. It enable us to translate something abstract with a 1% increase in volatility into something that's much more tangible. We have strong feelings, strong feelings, basically. So that's really helped us to make a much more intuitive decision.
Are these numbers symmetrical so that a 25 basis point decrease in expected return would increase the contribution falling above 35 by 4? I mean, can I just change the signs all the way through?
My guess is yes. I will defer to my colleague Paul Zhang.
Yes.
Okay, thank you.
Thank you, Paul. Yeah. So this will show how we can use these very key risk considerations to help us to pick a policy portfolio. And with something actual that what we presented to you in June, the risk factor analysis, we also showed you that, in terms of risk factors, how these 5 preliminary candidate portfolios stack up against each other. If you look at the blue bar and the purple bar together, or the top 2 bars together, these are really more like the equity-like risk. And you see that all the portfolios are predominantly in equity risk. And again, that highlights that because all the candidate portfolio are clustered together at a certain region of the efficient frontier. And this slide shows that compared to our current policy portfolio, which is the pie chart on the top, shows the risk contribution from factors. If we compare that risk contribution from the risk factors using our current portfolio, how does each one of the 5 preliminary candidate portfolio today compare to that? And in the interest of time, I'll just skip through this slide quickly. And I think this slide is probably much more intuitive to you. So this shows that compared to our current policy portfolio, in terms of risk contribution from each asset class, what are the difference? And if you look at the low-cost portfolio compared to our current policy portfolio, remember that low-cost portfolio does not have any private asset classes. So most of them are in public equity, and then about 20% in fixed income. So when you see the table below, the very first row of the table, you see a big blue bar on the positive side, means that when compared to the current policy portfolio, the low-cost portfolio increased risk from public equity. And then the big negative red bar on the left shows that we have reduced risk from private equity because the low-cost portfolio does not invest in private equity at all. So with the information from this integrated asset liability decision-making framework that gave us the 3 key risk considerations, on top of that, we can also use something actual, which is our risk factor decomposition analysis to help us to pick the candidate portfolio. And
You buy it. Sold.
So, is there any question, comments at this point?
Yeah, and again, the point of putting this information out here tonight is just to give you just something to think about. This will come back in the morning, first thing, before we have the stakeholder panel. We'll just quickly review this again, so you can think about the sensitivities on this stuff. That's really the point of this this afternoon, is to just get that thought process started. And then we'll be querying the sensitivity and the preferences that you have for different places on the efficient frontier and different risk elements later on tomorrow morning through this sort of clicker exercise. And I think, unless there are other questions, we're done.
Okay, well, thank you. That concludes today's agenda, and as we know, these are some complex but important issues, and we'll have a full day of robust discussions, and we will continue this process tomorrow. And again, thank the staff and board members for the participation, and also the consultants. And we will look forward to seeing you at 8:30 in the morning, same place. So have a good evening.